Hey guys, so this is a video I'm putting together on how I enter my trades. I get a lot of questions asking how do I enter trades and why and if I could go through my process. So in this video, I'm going to go through four things. One, the two setups that I use to enter stocks, that is breakouts and pullbacks. I'm going to talk about the three possible scenarios that you're going to face every morning whenever you enter a stock and how to deal with each of them. Then I'll go through what RVol is, short for relative volume. And lastly, I'm going to talk about where I put my stop loss and three cardinal rules for it. So let me start with two entry setups that I most commonly use. That is breakouts and pullback buys. Neither of these were invented by me, and these are very popular setups, but that's for a good reason. They actually have very high win rates, and that is which means very high probability of working out. So let me show you an example of both of these. And these are stocks that I just took an entry on recently. So a breakout is a super simple setup. All you have to do is find a stock that's gone up 3 to 5 days and has had a lot of volume throughout that move. So basically it's showing momentum, and if it has a positive catalyst, that's even better. And after going up for a few days, it's basically going sideways on low volume and consolidating. And once it starts doing this, you simply draw a line where the stock is facing resistance. And once the stock breaks through that resistance, you enter. That's all there is to it, really. It's really simple, but very effective. Now, a pullback buy, this is a variation of the breakout setup, and personally one that I prefer because it gives you a better risk reward. And I'll talk about that as we go ahead. The setup is similar in the sense that you find a stock that has momentum, something that's gone up, 2-3 days, and has had pretty high volume. And in this case, you could see that Apple pushed up for 4 days with little pause. So that's pretty high momentum. Now, what happened after was that the stock just pulls back to the moving averages, usually the 10 or 20. So it goes down slowly, but on below average volume. The lower, the better. And it decides to break out again. You do the same thing here, which is you find a short-term resistance. In this case, it was the high of the small hammer and the candlestick that followed. And as soon as it takes at that level, you go long. Now, once you've identified a stock that is either a good candidate for a breakout or a good candidate for a pullback, the next thing you want to do is plan your exact entry, which is exactly where will you enter the day of the breakout and at what level. So every morning when you come into the market, within the first 10 minutes is when most of my entries are decided. And there are three possible scenarios that you could be facing. So the first scenario is where the stock gaps up. So this one, for example, of Nvidia, this is the stock that I bought on, this was back in January when the rally kicked into gear, and this was my entry. So this is the daily chart, and then this is the 5-minute chart. And on the daily, we could see that gap right between yesterday's close and today's open. So there's a decent sized gap there, which represents strength. So if a stock is doing this and you still want to enter on it, how and when are you going to enter? Well, you're going to enter on the 5 or 10 minute opening range high. You could choose between the 5 or 10 minute range. It's completely up to you as an individual. I personally prefer 10 minute, but the best way you can look at it as is the 5 minute is for more aggressive entries, whereas the 10 minute and also the 5 minute is generally considered to be standard. But if you want to be a little more conservative, like myself, I generally gravitate to the 10 minute opening range high. It's completely up to you though. Now, what exactly is the opening range high? Well, for the first 10 minutes, you look at the 10-minute chart. You change your time frame from the daily to the 10-minute, and you wait for the stock to make that range. It's basically carving out a range within the first 10 minutes, and during that time frame, you just sit on the sidelines. So it makes a candle on that 10-minute chart, and this is the high of the candle, and this is the low of the candle. What I do is I enter right when it takes out the high of the first 10-minute candle. And you could also wait for the candle to close above the first range to play it safe or be more conservative. So it's basically breaking out of that 10-minute opening range, and that's where my entry was. And I simply put the stop loss just below the low of day. And I'll go into details about my stop loss when we come to that section at the end. So hopefully this is clear. whenever you have a gap up in a stock that you're looking to enter, you're going to enter on the first 5 or 10 minute opening range high. Now, the second possible scenario is that your stock crosses the previous day's high or the pivot line, which is your resistance, within the first 10 minutes of the market opening. Now, I don't generally like to enter stocks within the first 10 minutes, and that's because there's usually a lot of volatility and fake outs or fake breakouts in those first 10 minutes. So I like to give the stock 10 minutes to settle down, make a range, and then I enter. Also, the first 10 minutes is usually when retail traders are most active. So there could be a buying frenzy and the stock just sells for the rest of the day following that if institutional traders don't follow through on that buying. So in 99% of cases, I would wait for that first 10 minutes before I enter a stock. But the only time I would make an exception is if we're in a raging bull market, or there's a really strong catalyst for a particular stock or the market, or say the market already has a very established trend. Now, in that case, I might enter after 5 minutes rather than the 10. So I would enter at 9:35 if we break out instead of 9:40. So sometimes, because of me waiting for that first 10-minute range to close, what happens is the stock will break right through that resistance, which if you look at Gatto was this line right here, and that happened and that happened within the first 10-minute candlestick. So what do I do in that case? It's very simple. I do the same thing that I do for gap ups. I wait for that first 10-minute range high to be taken out, and then I enter the stock. So in this case, this was the first 10-minute candle, and as soon as the high of that candle was taken out, I entered. Okay, so that is the second possible scenario. If the range of the pivot line or resistance or previous day's high, whatever you want to call it, is taken out within the first 10 minutes itself, you do the same thing and you enter on that 10-minute opening range high. Now, once again, it could be 5 minutes or 10-minute range high. It's completely up to you as an individual. Now, the third possible scenario, and this is one I prefer, especially while trading options, is that the stock stays below the pivot line for the first 10 minutes. The pivot line is the previous day's high in this case, if I didn't make that clear earlier. So the high 1 day ago. And if the stock is opening within the range of the previous day's candle or gapping down, then how do we enter it if and when it does take out the pivot line? Okay, so this is the example of NVIDIA from January 19th when it pulled back to its moving averages for the first time since its initial breakout. So this stock opened here in the first 10 minutes. So it opened within the previous range, it opened within the range of the previous day's candle. Then all I do is I set an alert about 10 to 20 cents below the pivot line so that if and when throughout the day it does take out that pivot line, you're going to be alerted to it. So this is one of my preferred methods because you get to buy exactly at the pivot line and you can get some time to plan your entries and see how the day is progressing without having to pile into stocks within the first 10 minutes of the day. So these are the three possible scenarios in the morning, every day, right at open that you could face. And based on how the stock is opening and based on how it does within that first 10 minutes, I decide which entry tactic I'm going to use. Now I'm going to move on to the most important criteria that I use to figure out whether or not I want to enter a stock, and that is our RVol. So a lot of you may be wondering what is RVol, which stands for relative volume, and I'm going to show you what RVol actually looks like and where I get it from. This is Thinkorswim, the charting software, where you could also trade directly through. It's a brokerage as well, and it's one of the best softwares in my opinion. I recommend it for anyone that's trading the US market. And RVol is an indicator that you can add to your watch list, as you can see right here on the far right column. And you may be wondering how you can get that. I have a custom indicator that I put together. It was nothing special, but I'm going to drop it in the video description for anyone that would want to try it out maybe and potentially add it to their setup long term. And I'm going to show you real quick just how to do that. So you're just going to get that link, copy it, go to setup at the top right, go to open shared item, just paste that link in there, and then you're going to press preview and then import, which I'm not going to do it because I already have one. Once you do that, you're going to go down here to your watch list or wherever your watch list is located. Press on that little gear cog at the far right, customize, you're just going to type in the title of that indicator, and then you're going to add item, and it's going to now be part of your current set. And then you could reorder that set however you want it to populate at the top. So that's how I have it currently. I like it, it works for me. I just want to give you guys a quick tutorial on how to do that, just so everyone knows how to do that. Now, what is this RVol? It's a number that tells you what volume the stock is trading compared to how much it trades on average. So this number could be either green or red. If it's green, it means the stock is trading more volume today than it trades on average. And if it's red, then it's telling you that the stock is trading less volume today than it trades on average. So let's have a look at my watch list and see what we're talking about here. So if you look at TDOC, you can see right over here, this orange font shows the average volume that the stock is traded at over the course of on a 50-day moving average basis. So basically over the course of the last 50 days, what the average was. And then that blue font is telling you what it traded at for that current day. So if we look today, we could see that the average is roughly 4 million. And today it traded close to 24 million shares. So it's basically telling you that if you look at our relative volume over here of 6.82, it's telling you that this stock traded close to 7 times the volume that it would trade on an average day, which is really important to know because volume is what supports a move. So if you're buying a breakout, you want there to be volume accompanying that move because that gives it a stronger likelihood of panning out favorably. Now, if you look at, let's say, Microsoft here, the average volume that it usually trades at is about 30 million shares. So the stock is trading just 0.65 of the relative volume, which is basically telling you that it's trading 65% of the daily average at this point, which the market's closed. So it traded only 65% of the regular volume or average volume, or 35% less than the average volume. Okay, so that's all that RVol is. Now, how do I use RVol? What we need to remember first is that, say we're buying a stock now at 2 p.m., we really don't know what that final volume for the day is going to be and how many times the average the volume is going to be, right? So RVol is just there to help one speculate if a stock is going to trade on higher volume than average based on its current rate. So let's say it's 11 a.m. and the stock has already traded 60% of the average. You could pretty confidently assume that it's going to trade at an above average volume by the end of the day, considering there's still, 4 or 5 hours left. It just helps you visualize what the end of the day is likely going to look like. So this is never going to be 100% accurate, except at the end of the day. And as we progress more and more into the day, that projection will be more and more accurate. So at 9:30 or 10 a.m., it's going to be pretty inaccurate, but it still gives us a general sense of direction. Are we trading higher volumes so far than we usually trade up until this time or not? So that's how I figure out what the RVol is likely to be at any given time. Like in this trade for DraftKings today, which we entered, you could see that I entered at around 10:40 a.m. And at 10:40 a.m., I factored into my analysis the fact that RVol was already at 0.7, meaning it already had traded 70% of its daily average volume by this time. So within an hour and a half of the market being opened, it already traded 0.7%. So the likelihood that it's going to trade above average is very high by the end of the day. And if we look at the daily, you can see that that's exactly the case. So it traded at 1.6 times the average. So that's exactly what you like to see on a breakout. Okay, so now let's go through a few examples of how I use the RVol. So say this is what my watch list for the day looked like. What is this telling me? Well, what it's telling me is two things. One, most of the stocks on the watch list are down on the day. So if I'm looking to buy a breakout, then the environment is not really good for that and I should stay away. And two, what it's also telling me based on the RVol is that these stocks are going down on heavy volume. Now, volume actually confirms the price, so it tells you whether the price movement is likely to stick or not. So in this case, It's telling me that, yes, this price movement is likely to sustain. And since stocks are going down on very heavy volume, I should definitely stay out and not try to buy breakouts right now. So you might find one stock on your watch list that's breaking out. But are you going to be desperate to buy that one? Most likely not, since the environment is not conducive to breakouts. Now, suppose my watch list looked like this in the morning. What is it telling me? Well, ask yourself. First, it's telling me that the market is really conducive for breakouts. Most of the stocks on my watch list are green on the day, and also they are all up on high volume, which means a lot of serious buying is coming in. And this is the kind of environment in which you want to buy breakouts because they're more likely to actually have follow through. Now, let's take another example. So what is this environment telling you here? The percentage change is mixed. So a few stocks are up and a few stocks are down. But also look at the percentages. The stocks that are actually up, are they up big? Not at all. Barely at all, really. And more importantly, if you look at the RVol, everything is red except for one of them. Now, in this kind of environment, I'm not really convinced that the buying is coming into the market, and more importantly, that it's going to have any kind of follow through. So this environment would again make me want to sit out. Now, of course, this is not a foolproof system. It's not going to work every day. What we're dealing with, though, is probabilities. And probabilistically, this was very unlikely to have follow through, given the rest of the market was not really going up and there was no volume coming in. Now, let's look at one last example. Say this is what my watch list looks like. Predominantly red with few high volume movers. What am I going to do in this environment? Again, sit out. This does not tell me that a lot of buying is coming into the market. There's very few stocks going up, and that too by a very small amount. But more importantly, the volumes aren't there. If the volume is not there, the likelihood of follow through is really, really low. So this, again, will not interest me and make me want to sit out. So hopefully this gives you a good sense of what RVol is, how we can get an indication early in the day and at any point in the day of what the RVol is going to be at the end of the day, and the 4 different scenarios that you're likely to see every morning on your watch list and what it's going to look like, and how to interpret the price and volume change, whether you should be bullish on the market, bearish on the market, and how aggressively you should be buying breakouts based on what the RVol is telling you. Okay, now there's one more way to use the RVol, and that is to combine it with news, so a catalyst of sort. That makes the RVol even more powerful. Sometimes what you're going to see, and this is a live example from last week in a stock that I currently hold a position in, and what I saw was the RVol opened very high. You could see this on the 10-minute chart as well, where volume came in very strong. And at that point, the RVol turned from red to green. So when situations like this happen, what I usually like to do is search if there was any kind of news item or catalyst that just came out that might make that stock pop. And in this instance, it was not hard to find, as it was off of an earnings beat, which is obviously positive news that seemed to be getting a strong positive reaction given that stock the nice pop right off the open. Now, how will I use this? The combination of news and RVol? Well, since it had gapped up at market open on very high volume, which was backed by a catalyst, I just placed my stop loss up to the low of the day, or just below low of the day, because with a strong catalyst and the big volume that came in, there should be no reason for the day's low to be taken out. So my thinking was that since it's just going up on legit news that is positive, which is the strong earnings, that's all I really need to know. Those are the keywords. And if the stock is truly bullish, it's not going to take out that daily low. And if it does, it's not ready yet. And I would just move my stop up incrementally as that trade turned positive, making the trade free. And by trade becoming free, what I mean is even if my stop loss is now taken out, it's going to exit me at the cost price and I'm not going to lose a single dollar on it. So using the RVol in combination with a strong catalyst can give you a lot of minute data that can actually help you manage the trade much better. And you can actually do the same thing when you're entering a stock as well. So JP Morgan, for example, when I bought it on the gap up, you have to keep in mind that you usually want to check if there's any kind of catalyst when you're dealing with gap ups, because if there is, that's a big positive, and that's giving you more additional conviction to get involved. So stock going up is good. RVol added to that makes it really good. And if there's some sort of news catalyst behind the RVol, that makes it really, really good. And that's the bottom line, really. Okay? Now, the last part of how I enter stocks is putting a stop loss. This is super important, and there are 3 rules that I usually follow for a stop loss. And these are rules that I never break, or rather should never break. Sometimes I do, but we're all human. So the first rule is if you're buying a breakout or a pullback buy, you want to put the stop loss at the low of day. The idea behind it is really simple. If the breakout is real, it has to have follow through. It's never going to pull back and take out the low of day, which is now support. And if it does, that breakout has anyways failed and been invalidated, and you wouldn't want to hold that stock anyways. So instead of going through a really complicated process of where I should put my stop loss, what's the stop loss on this, blah, 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 and asking yourself every single day, just remember the main rule, which is put your stop loss at the low of day, especially if you're trading breakouts and pullbacks. Different setups might have different stop loss rules, but for these 2 setups, the rule is very clear. Put the stop loss at the low of day. Now, this is a rule that is not very commonly talked about, but you want to also put stop losses at less than 1 ADR to maintain the risk reward. Now, what is ADR? ADR is the amount that a stock generally moves in one day. So it's the range of a stock in one day. And I'll take you through a few examples. What I want to show you is that stocks with different ADRs need different percentage stops. And once again, I'm going to include the indicator in the description for anyone that's interested. I always have it added here on my charts so I can quickly refer to it. So let me show you some examples. Now, SPY has an ADR of 1.1%, as you can see right down here. What does that mean? On average, in the last 20 days, the intraday range of SPY, which is its range, is 1.1%. Now, let's compare that to something like DraftKings, DKNG, which is 4.3%. What does that mean? In the last 20 days, the intraday range of all of these candles within this box, so the last 20 candles, was 4.3%. These, as you can see, can have a pretty wide range. If you're trading a mega cap stock like, let's say, Apple, you're going to have a very low ADR of 1.6%. But if you're trading growth stocks like BBIO, which I took today, it can have an ADR of up to 8.8%. And with many growth stocks, it can exceed 10%. Now, you're going to put the same percentage stop on all of these stocks? To me, that doesn't make any sense. I hear a lot of traders saying, oh, I put a 5% stop, or, oh, I never put more than a 5% stop. I always use a 2% stop, or I always use a 1% stop. None of those statements make any sense to me because each stock has a different character. If I went in with the rule of always using a 1% stop or 2% stop on a stock like DraftKings or BBIO, that would make no sense. Look at how much range they trade every day. And even on this day right here, which actually looks small, the range was 5%. So using a 1 or 2% stop on this just immediately is going to get you stopped out in normal intraday volatility. And on the other hand, if I'm trading a stock like Apple and I'm putting a 5% stop loss, that again makes no sense because that would be too wide for the stock. Now, the other way to think about it is also how many days would it take that stock to make that kind of move? If Apple is moving at 1.6% a day, and I'm using a 5% stop, for Apple to even go up 5%, it's going to take 3 days on average. Now, For it to go up twice of how much I risk, it's going to take 6 days on average. So again, the stop loss makes no sense and it would be too wide for Apple. So what I would always do is look at what any given stock has as an ADR and then put a stop loss which is less than the ADR of that stock. So if we're trading Apple, I would use a stop that is less than 1.7%, or I'm sorry, 1.6%. And if I were trading DraftKings, I would use a stock that is less than 4.3%. For BBIO, I would use a stop that is less than 8.8%, and so on and so forth. Hopefully the logic behind that makes sense and why I don't just use a blanket percentage for all of my stop losses, because the stocks in the US market have such variable characters. So that is my second rule of put the stop loss at less than 1 ADR, and that will help you maintain a healthy risk reward. So you're taking a reasonable amount of risk and expecting that if the stock goes up for the next 2 or 3 days, you're going to be profitable and could take partials off. Now the third and last rule that I absolutely always follow is that I always put a stop loss of less than 10% regardless of what the ADR is. So say even if I were trading GFAI, which has an ADR of roughly 38%, my stop loss will not be more than 10% ever. Why is that? Because of this. Losses work geometrically against you. This is just math. If you have a stop loss of 5% and the stock goes down 5%, you're going to need that stock to recover 5% to break even, which is fine. That's doable. If the stop loss is at 10% and the stock goes down 10%, it's going to need to go up 11% to come back to that original point. This is also doable and achievable by a stock, but this is where it starts to get really problematic. At more than 10%, if a stop loss is at 20% and the stock actually goes down 20%, it's going to need to go back up 25% just in order to break even. And if you put it at 30%, it's going to need to go up 43% and so on and so forth. So losses are working geometrically against you. Take a simple example. Say a stock is $100. You put the stop loss at $80, and that gives you a stop loss of 20%. The stock now goes down to around that 80 level, close to stopping you out, but then turns around. Now, if the stock needs to just get back to $100, it's got to go up 25% from that $80 just to get back up to 100. This is why $10 or 10% is my limit. That's the cutoff. This is a hard rule. You never ever want to break. It's just going to make it that much harder for you to recover the money. Okay? Now, the only nuance I would add here is if you're trading a stock that is gapping up. Then, if you're buying them after the open, you're going to use low of day after the first 10 minutes. And that's the same rule as what we do for any other trade or breakout or pullback trade. So hopefully this video on entries has been useful. The 2 setups that I use, the 3 scenarios that you are likely to encounter in the morning, what RVol is, and where I put my stops. If there's anything that I missed about my entries, I'm more than happy to follow up on this. If you found this video helpful, just let me know, because that encourages me to keep on making these. I'm not a professional YouTuber, but professional trader, and I want to start making videos that share my daily process because it could help a lot of people. So let me know what you think, and I'm always happy to answer any questions you have. Thanks.